Japanese government bond yields are rising, and the move is drawing attention far beyond Tokyo. Traders are increasingly betting that the Bank of Japan will raise interest rates sooner and more aggressively than officials have signaled. That shift in expectations is pushing yields on Japanese government bonds higher. Here is the basic mechanic. When investors think a central bank will raise rates faster, they demand better returns on the bonds they already hold. Prices fall, yields rise. That is what is happening now in Japan. What makes this significant is the context. For decades, Japan was not fighting inflation, it was fighting the opposite. Deflation, meaning falling prices, was the chronic problem. The Bank of Japan ran deeply negative interest rates for years, essentially charging banks to park money, all in an effort to push prices up and keep the economy moving. That era is over. Consumer prices in Japan have been rising at a pace the central bank can no longer easily set aside. The BOJ ended its negative rate policy earlier in this cycle and has moved cautiously toward higher borrowing costs since then. But cautiously may not be enough for markets. Traders appear to be pricing in the possibility that the next rate moves come faster and hit harder than the BOJ has suggested. When that kind of repricing happens, yields rise across the board. And that is precisely what the market is reflecting right now. The implications stretch well beyond Japan's borders. Japan is one of the largest holders of foreign assets in the world. Major Japanese pension funds and insurance companies have spent years pouring money into overseas markets, particularly US and European bonds, because domestic returns were so low. If Japanese yields keep climbing and domestic assets start looking more attractive, some of that capital could flow back home. That kind of repatriation can put upward pressure on yields in the United States and Europe, where markets are already navigating their own rate cycles. The yen is also in the frame. Shifts in BOJ rate expectations tend to move the currency, which in turn affects everything from Japanese exporters to the carry trade, a strategy where investors borrow cheaply in yen to buy higher-yielding assets elsewhere. A faster hiking BOJ disrupts that trade. For now, the key is watching the BOJ's communications. Any signal from policymakers, in speeches, meeting minutes, or official guidance about the pace or scale of future hikes is likely to move Japanese bonds, the yen, and global fixed income markets quickly. The practical takeaway: if you hold international bonds or track global rates, keep Japan on your radar. What the BOJ does next is no longer a regional story. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.